Hey everyone, I'm Jeremy Szafron. This is Kitco News. Don't forget to hit that subscribe button for the latest. Now, this week, the S&P 500 and the NASDAQ have been under pressure, reacting to mixed economic signals and anticipation of Federal Reserve actions. Now, the latest GDP Now estimate shows a 3.5% growth rate for the second quarter of 2024, but consumer sentiment has dropped to a 6-month low, according to the University of Michigan. Now, this combination of growth and underlying concerns is creating uncertainty among investors, to say the least. Major financial institutions, including Goldman Sachs, now predict the Federal Reserve will start cutting rates in September, with December also being a possibility. Now, the speculation has influenced bond yields and stock performance as investors try to position themselves ahead of potential changes in monetary policy. And despite low consumer sentiment driven by high prices and economic uncertainties, we've seen a strong job market with 175,000 jobs added in April. And this resilience in employment suggests underlying strength in the U.S. economy, even as consumers continue to feel the pinch of higher costs. Now, to help us make sense of these developments, we welcome back Ted Oakley, managing partner and founder of Oxbow Advisors, with over 40 years of experience in advising high net worth clients. Ted, you've seen a thing or two. Welcome back to the show.
All right, Jeremy, thank you.
I appreciate your time today. Let's jump right into it. As I said in the intro, GDP Now estimates for Q2, moderate growth, 3.5%. But consumer sentiment is at a 6-month low. Ted, with these mixed signals, what do you think this means for the economy in the second half of this year? And what indicators should investors be watching closely for here?
Well, you know, Jeremy, I don't use the GDP forecast too much. They missed it by about 25% in the first quarter. Yeah. So I wouldn't be surprised if they don't miss it in the second quarter, but I think it could be lower, not stronger. You know, a lot of GDP right now comes from inflation. You know, look at prices and do things, you do more business, that perks up. I don't think the economy is that strong. I think it's a real mixed bag. People with, you know, upper echelons with a lot of money, you know, they're okay. They feel okay. The market's high. The real estate's good. But, you know, over half the country right now is in pain. You know, they can't meet bills. And I think that's the bifurcation of what's going on right now. And you see the sentiment numbers showing up in that. You see it in real estate. You see it in a lot of things where, you know, like the PMI services, manufacturing, they've just gone back and forth a little bit. We haven't had a lot of change, actually, one way or the other. And I think investors need to think about that, because I would be surprised now. You know, you mentioned that Goldman might change estimated to change in September. But, you know, that's only about, I think, 7 weeks before the election. I would be surprised at that. I wouldn't look for a lot of change this year myself.
Okay, no change. We'll get to that. Let's go back to your original point here, you know, that some argue that this reported growth is just an illusion created by the inflation number. In a lot of ways it is. While the GDP growth is positive, isn't it possible that growth is not translating to the real improvement for everyday consumers here?
Well, no question about that, because, you know, last year was just the government putting money in. This year, they're not putting as much in. So you're not getting that push from it. And then if you look at retail, just use that as an example. Look at Macy's, look at Target, look at Walmart, look at McDonald's. I could just go down the list. You know, their business is down. Target's down 3 quarters in a row. I mean, there's a lot of reasons for this. But one is that the consumer is pretty much full up on what they can do. They just can't do a lot more. And, you know, they borrowed up a lot. Car payments are up a lot. Insurance way up. And so it squeezed them to the point to where that segment, which is half of the country, is really in a hurt right now. And I think the upper 15 or 20% doesn't realize it. They don't think as much about it, but that's what's going on in the country.
Yeah, there seems to be such a divergence. Just before coming on the air, we were talking about, as prepping for this interview and watching your talk with Jim Bianco. We had him on our show not long ago, and he tweeted about the Fed needing to do an emergency rate cut because there's Palm Beach housekeepers that are making $150,000 a year, and you can't find them. So I'm wondering, you know, what's the divergent here? What's the real picture? What are we really dealing with?
Well, I think a lot of the elite affluent at that level don't really have a clue as what's going on in the country. I mean, I hate to say it, but they don't do anything for the world a lot of ways, and they're trying to find probably a housekeeper that can be a home manager as well as a housekeeper. And I don't think that's indicative of the U.S. whatsoever. I go all over the country, and so I see quite a bit of this. And I love housekeepers, and I've had the greatest in my whole life. But the point is that I think Jim was tongue in cheek, knowing him well as I do, and it's interesting to see. But I think he was trying to throw something out there to all the people that think your rates won't come down. They think they're coming down. He thinks they're not.
Yeah. Yeah. Well, let's get to that and let's get your take. I mean, as I mentioned, Goldman Sachs and other analysts are predicting first in maybe September. There's a lot saying December, some on the none at all fence. I mean, Ted, I started the broadcast back in January pricing in 6 to 7 cuts. So it has been quite crazy. But could these expected cuts possibly improve the sentiment here and give a more positive outlook? And if so, how can investors prepare to take advantage of the potential changes?
Well, Jeremy, they'll take it as a trade. And just think about it like this. If the Fed funds rate's 5.5, how many times do you think they'll cut before election time? My guess is if they did anything, it would be 1, which would make it 5.25. But let's just say they do 2, which would put you at 5%. And normally, your 90-day Treasury is going to trade up close to that, say 20 or 30 basis points away from that. It would be hard for us, at least, to go out and say we want to buy the 20 or 30-year bond with the idea that they're going to move a half a point or 2 quarters when I can get that much, in the 90-day or 6-month Treasury. As a trade, that doesn't make any sense to us. I think you'll get, if they break, drop them off, you'll have people trade that, but it'll be ephemeral. It'll last 1 or 2 days and it's gone away because it really shouldn't affect what's really going on out there.
Yeah, there's been so much volatility, obviously, in the markets this year, too. We've seen all-time highs in many different asset classes. But, this whole strategy of sell in May, go away, it's been fairly popular historically. I'm curious, looking at today's market, we see these highs, subsequent volatility this year. Do you think that this is still an approach? Maybe it's irrelevant here. What are you advising investors?
Well, Jeremy, it depends on how long you've been around. I've seen some summers where, the markets didn't do well at all. And I've seen some where they did really well. It usually has to do with what you've gained that point in the year. I remember in '87, we did a study. The markets were up something like 20% by June. And we did a study to see what our chances were of the markets being up 30% by the end of the year. They were quite low. That influenced us to take cash off the table. Here, I think that not that. I think it's a situation where things are really overpriced and people are just complacent. They don't care. They're going to go away. And then if something happens while they're gone, then they'll show back up and, get fearful again.
Yeah, it's funny. I mean, we talk to a lot of people that say that there's a bubble and it's happening in front of our eyes. And, with the strong job numbers and resilient and consumer spending, is there a possibility for ongoing strength here in the market throughout the summer, do you think?
Well, I'm sure there is. But if you look at multiples right now on the S&P, you're 27 times. You don't start super bull markets from 27 times. And if you look at the cyclically adjusted, the CAPE ratio, it's about 34. The price to sales is right at 3 times sales, 2.8 or 2.9 on the S&P. You don't buy companies like that and make any money. The only reason the markets are up is because of basically, 4 or 5 stocks. I mean, NVIDIA was, something like 25% of the whole move. And so it's in those situations where I think the average investor has no clue of how markets are situated as far as how companies inside the S&P are situated. If you look at the other 495 companies, they're barely pulling the weight.
Yeah. Has anything surprised you here, Ted, when you look at the kind of numbers that we're seeing in terms of, the consumer spending in the future? Don't you think that wage growth isn't keeping pace with inflation on this front?
I don't think it is, no, Jeremy. I don't believe it is, because if you see it, normally in consumers at certain points, graduation, Christmas, Thanksgiving, you'll see them do anything they can to really, push those consumer numbers. And what we've seen now, though, I think this is a difference now. is that if you look at their insurance costs, cars, insurance costs on homes, their taxes on their homes, you look at what they're having to pay, 22.25% on credit cards, and the delinquency. People blow this off, but you need to watch it. The delinquency rates on auto payments and credit cards has really turned a lot in the last year. Is it where it was at one time during COVID? No, but that's an anomaly. That's a one-time and 50-year deal. You can't really use that. And so I think people have to wake up as to what's really going on. I mean, I know a lot of people in the apartment business, and they're getting some drag, and people slow pay.
Yeah. Okay, well, give me your forecast here for the end of the year. I mean, given the potential of interest rate cuts, the ongoing inflation that we're seeing, what strategies are you advising investors here, Ted, who want to keep their portfolios balanced and resilient, but still, a bit of an ROI?
Jeremy, when it comes to forecasts, we're not really good at it because nobody ever knows. And so I try not to forecast, but I will tell you what we're doing. And I think that's more important. If you look at where we are today, we still own on all three strategies, which is conservative income, high income, and then stock strategy. In all of those overall, we have between 40 and 52% in short-term treasuries. Now, by that, I mean somewhere between a year or less, but a lot of it is floating on the 90-day rate. That tells you a little bit about what we're thinking right now. Our different allocations than we've had last year. We have obviously last year we had a lot of more gold miners. We added more energy. We've always owned the pipelines. We still do. Those are something we don't usually sell at any time. And if you look at the common stocks that we've picked up, we've done a lot of consumer staples. You'll see where, we bought, McDonald's and Kimberly-Clark, the Unilever, those kinds of companies that do well when times are just not that great. And do we own the legacy tech stocks we always own? Yes, we do, but less of them. We've sold those at probably 4 or 5 times over the years. And we feel really good about what we own. And if markets were to break, and we thought there was a better risk reward than the 5.2 I'm getting in the floater, we would move on it. But we see a lot of stocks. We basically run about a 250 stock screen. We don't have that many stocks that are just really, really cheap right now.
Yeah, no, valuations are quite high. I mean, you talked a little bit about those high yield investments. They come with higher risks, especially in volatile sectors like tech and renewables. I'm curious, how do investors ensure that they're not overexposed here, Ted? You mentioned that you were taking a bit of profit here.
Well, it depends on what it is, Jeremy. As an example, we have had a lot of energy. We're overweight energy coming out of last year and through the year last year. And all we did there was, let's say your total energy was 10% and you go to 2. It's not like you're not in the game. Now, when it comes to income side of energy, we own the pipelines and we have some great pipelines. We don't sell those. Most of those are tax advantaged and we don't have any reason to sell them. I can make the case today that a pipeline on a K1 is a better investment today than commercial real estate or even apartment real estate right now, because I can get 7.5% to 8% on the cash flow. And and it's solid, it's always there. On the other side of the stock side, I'll give you an idea about what you trade. We owned last year to cheap prices, United Health. We owned it a long time. But it got up pretty high and we took some off. We added some back when it fell back again. Then it got overvalued here for us, at least in the last 2 or 3 weeks. And we sold most of it, but we go we move forward and go to something else. It's not like we're trying to trade the market every day or something like that. We shoot for long-term capital gains. And I will tell you, most of ours are long-term.
Yeah, and it's a good strategy too. Rewind a little bit. Tell me a little bit more on the equity side on energy plays too. I mean, obviously we see the price of oil down today, but I'm curious for that long term, retail consumers probably going to come back into the market because they realize that, it's not going away anytime soon. We're still dependent on this stuff.
You have to think about oil like this. And if you look at, and by the way, I've traded oil companies all the way back to 1980. But if you look at oil companies, they're not like something you can buy and just hold it for 20 years. They have periods of outperformance, and it might be 5 years, it might be 8 years. There's a number. And I happen to think they're going to do really well this decade, because I think people have misjudged the green EV look here. I think they misjudged that quite a bit. Not that I'm against that or anything like that. I'm obviously a conservationist, but my point is that if you own situations where, and we feel like we've owned the best. I mean, we own Exxon, we own Williams Brothers, we own a lot of pipelines, MPLX, we own an Enterprise Product. Like I go down the list that we have, but sometimes some of the producers, not the pipelines, some of the producers get a little bit extended, and you can look at it and say, well, that's not the time we'll put any new money into that. And oil you have to be careful with it a little bit because it will throw you off. I remember 1977, oil went up, the market went down all year, and oil went up all year. Yeah. So it depends on what's happening, but I think there's everybody should own some energy now. If you're biased against it because of climate, et cetera, I understand that. I'm not trying to convince you, but the main point is we think it has a lot of upside to it over the next 5 years.
Over the next 5 years, mostly cyclical, as we see in that commodity space too. I've certainly known a lot of people that have had their heyday in oil and gas and then have ended up without a job for a year or two too. Talk to me a little bit about utilities in terms of some of this safe money that we weren't looking for before the start of this year seems to be great bets. Is there any equities on that side?
Well, we own a couple of utilities and Entergy and public service, but we are not, there's 2 or 3 of the utilities that are really getting a big play off of AI.
Right.
And we don't chase things like that. They don't, we look for companies that we think, okay, they can pay that cash flow for a long, long time and increase it. I think the utilities will be better than people expect because we're going to put some major pressure on our electric grid. And if we don't come up, and I tie that in with energy, you can't, there's no way. I mean, if you look at this administration that just came out and said, hey, no more LNG. We're not going to let you have any more permits on that. And oh, by the way, the next 2 years, no coal plant. You have to get rid of your coal plants for electricity. And then right behind that, we're going to do natural gas. Well, you know how much that is of electricity? It's probably 40% of the market. I'm like, you can't cut out all electricity just because you want to say, hey, I love green peas. That won't work in the world. You have to get something that's pragmatic. And if you're going to make it work, get a plan and make it work the right way.
Yeah, especially while everybody's using more on their technology these days, it requires a lot more power. Okay, well, it's interesting because talk to me a little bit about the debt markets. I mean, there's a concern that the debt markets might not react as expected due to an already low interest environment. But how should investors navigate this in terms of limited returns, traditional debt investments? What are you looking at here?
Well, Jeremy, could I say one thing before we go on about the energy, and I'll be happy to answer that.
Yeah, I love it.
If people are so hung up on AI right now, why don't you go use some AI to figure out what the electricity, oil and gas situation is going to look like over the next 3 or 4 or 5 years, and then come back to me. That would be my answer. Secondly, but on the debt side, I think your question, if you'll re-ask it, I'm not certain what I got there.
You know what, I want to go back there because I think that was more important to talk about because there's a lot of people that talk about the AI community using it, power in the grid, what it's going to take. Over this next 3-4 years, you think that's the oil and gas play? Because there's a lot of talk about uranium, small modular reactors, some other sources of electricity that are needed here, but they're not overnight. It's not going to be up and running tomorrow.
Well, I know people that are in the small nuclear thing, trying to get it to make it a corporation kind of thing, where corporations can have that, and that's all well and good. The problem is that if you look at what it takes to make solar, what it takes to make wind, energy is a major, major component of that. And when I said AI, if AI is so good, why don't we use it to determine how we're going to work through all of them? In other words, you got to break it back against itself. Say, hey, I'm the big user, but I'm the smartest person in the room, AI. So tell me what this is supposed to look like the next 5 to 7 years. See, it's ironic, I think, in a way, but that's the way I look at it from time to time.
Yeah. Okay, talk to me quickly before I let you go here, Ted, just about, we referenced really quickly that we're going to be seeing some elections this year. I mean, the United States isn't the only country. There's quite a few in the G7 at least. I'm curious, Policy-wise, I know the Fed wants to be a little different here, but what are your top things that you're looking for going into it? Is it things like debt?
Do you mean
Government debt? How are we going to do that?
Well, Jeremy, that's a great question. If you had that answer, then I would hire you for sure. And the point is, we really don't have a good answer for it. The problem we're running into is they're not buying the bonds overseas, and they have the same amount they've had for about 6 or 7 years. So all the buying has come from ourselves, you see? So we're buying in pension plans, we're buying in, states buy, the Fed buys their own bonds, individuals own a lot of money markets, et cetera. The problem with all that is that you do get in a situation after a while, so you're using so much of the money you create in the country to buy your own bonds, that you start getting in a situation where the old crowding out that you learn in business school, that's what that is. In other words, you don't have enough money to run the machine. And I think over the next 5 years or so, I think you're going to really come to the point to where, I hate to say it, but I think there will be a point to where they have to really get down and do something, because there'll be some real problems.
Yeah. Yeah. Has America changed its stance here in the global take? I mean, think about the emerging markets. A lot of people are looking towards them right now, and that's where they're placing their bets.
Well, that's not probably a bad idea in some ways. I think Americans need to think a little bit about this. And I'm as pro-American. I'm a U.S. Army veteran. Don't get me wrong. I wave the flag. But here's the problem. If you look at Pax Americana, which is us leading the world, that's not here. Okay, yeah. We right now we have, if you look at natural resource group, top 4 natural resource countries: Russia number 1, China number 4, we're number 2. Okay, Canada's right in there, number 3 behind us. But here's the point: we're playing this game of wanting to be number 1 in the world when we're really not. We don't have the military power. There's a lot of things, and yet we're acting out as if we do, which means that somewhere along the line you get into trouble, because instead of being a unipolar war anymore, you're a multipolar war. I mean, and look at all the people that really don't want to do business with us. Yeah. And you can keep throwing sanctions on people, but it comes back to harm you in the long run. Trump did it, Biden's done it, and those don't work in the long run. And I think where people mess up is not realizing we're in a world situation right now, and that could have some effects on the U.S. economy.
Yeah, absolutely. I mean, you saw it with President Biden just meeting some leaders of Africa. You're starting to see some investment into that region, almost as if, oh, wow, I was a little too late to this. So I'm curious to see this next little while where it evolves in the world community.
Well, it's getting stickier, Jeremy, all the time. I mean, you look at relations between Russia and the U.S., China and the U.S., to a certain degree, India and the U.S., but certainly Saudi in the U.S., some of the South American countries. And I'm just looking at it from a standpoint of, if I'm looking at buying a company, I want to know where they do business. Yeah. And I think some of the ways we've gone about this with those foreign countries has turned them the other way. In other words, they want to get away from the dollar. That means they're going toward gold, they're going toward metals, they're doing other things to get away from the U.S. dollar.
Yeah. And what do you think, Ted? I mean, I could talk to you forever here, but what do you think about the policy work when, in the U.S., the government says, okay, you cannot get the resources out of the ground, but I'll go to Africa and we'll invest there and we'll take them from that region. Like, what's happening here?
Well, on the energy policy, I think we are in a big hypocritical policy. I mean, it's interesting to me. We have the capacity to produce a lot. I mean, and by the way, over the next 50 years, energy is going to decline. Obviously, everybody knows that. It's just a timing factor. Is how you're going to do it over time. And I think to harm the American people who buy gasoline because you want to say, hey, I'm a different way, and we want to be the world leader in green. That's okay. It's just your timing's off. And so what'll happen is you'll get people into an inflationary situation with energy,
Yeah, and we've certainly seen it on the cost front. That's all the time we have, but Ted Oakley, managing partner and founder of Oxbow Advisors, joining us again to unpack all this. Hey, thank you, sir. I appreciate your time as always, and I'm looking forward to having you back on the show. Maybe Q2, we can talk a little bit about this in review.
Jeremy, always appreciate it. Thank you.
Appreciate it, Ted. Thanks so much.